What's going on, guys? It's Eric here with Traveling Trading, and welcome to the Stock Market for Beginners course. All right. So, before we get started, I don't usually ask you guys in other videos and stuff like that, but I'm asking this one. Please like, subscribe, and comment below on this video, so that way we can help other people who are interested in learning about the stock market be able to find this video and educate themselves with the financial markets. Okay. So, without further ado, let's go ahead and get into it. A little bit about myself, because I know you're wondering who the heck am I. Basically, I'm Eric, founder and creator of Traveling Trading. What we do here is we, discuss traveling and trading, mostly trading. But basically, we like to educate people who are interested in the stock market about the stock market. We discuss trading on a daily basis and different aspects of it, but we also discuss traveling and other things like that because pretty much finances is something that connects the world, and it's a big world out there, so you know why not explore it and live life. Right? So pretty much what we're going to do here in this course is learn about the stock market and get you some good foundation on this particular financial market. All right, so before we get started, understand this is not financial advice. This is for entertainment and educational purposes only. Now, it's going to be a lot of information covered in this video, so you might want to go ahead and, get your popcorn ready, get your notepads and things like that ready, because you're about to get hit with a lot of information, but not too much information, enough so you can feel more confident with going into the market and being able to become either a successful trader or investor. All right. So let's jump right into it and talk about, what the goal is for the day. All right. So got my water here too. A little bit about what we're looking to do here today. We're going to introduce you guys to the basics of the stock markets. Okay. You're going to learn about what a stock is. You're going to learn about the market itself and pretty much how to, be a stock trader. All right. This is going to allow you, hopefully, to pursue getting more knowledge and experience into the stock market if you choose to, or at least, find out about it and understand, hey, this might not be for me. Either way, you're going to learn something today. That is the objective here. Also, third thing, hopefully, is to make your money. I want you to use this information you're gathering to hopefully, make yourself some money, get you some value out of this, regardless whether it be material with, money or just, from knowledge itself. Either way, I want you to gain some value from this video. Okay? So that's the goal here for today. Now, who is this course for? Pretty simple. If you're new to the financial markets, if you've never heard about the stock market, or if you did hear about it but don't, haven't got any education on it, this course is for you because you're brand new. Perfect. Good foundation here. This is also for experienced traders who are in other markets and are interested in the stock market. By that, I mean if you're someone who trades crypto, if you trade Forex, if you trade futures, commodities, things like that, and you're like, hey, I've heard about the stock market, but I never really got into it, this is a good course for you to get yourself some good foundation. Okay. Also, this is for someone who wants to just try to become an investor, grow their wealth, maybe even, hedge against inflation, things like that. This is a good course for you to get that foundation on ways to do so. Okay. Um, so that's what this course is for. If you're someone else, don't fit that criteria, move on to the next thing. Still like and subscribe, but you can move on to another video. This ain't for you. You'll waste your time. All right. But let's go ahead and get started. All right. So, what is a stock? That's why we're here, right? We want to know what a stock is in the stock market. I'm going to break it down simply for you. Put in the layman's terms, a stock is basically ownership in a company. Textbook definition, a stock, also known as a security, you'll hear that, referred to as a security, um, represents ownership in a company or corporation. This entitles the owner a portion of the assets in that company or corporation that's equal to profits of how much stock they might own. and that is typically in the number of shares or units, units or shares, basically shares. So if I say I own X amount of dollars or X amount of shares of McDonald's, I'm, technically, I'm a part owner of McDonald's and I receive shares or dividends from that company or, whatever. So that's basically what it is. The stock is ownership in the company and it represents ownership or portion of the ownership equivalent to how much of the stock you own. Textbook definition. Okay. Understand there are three different types of stocks. Well, actually, I mean, there's more than that, but mainly three different types of stocks and they're different classes. Class A, which is what we're going to be referring to and talking about, and what's mostly talked about, is common stocks. Okay, in the stock market, when you're trading and stuff like that, you're typically dealing with common stock. Okay, this basically refers to, ordinary ownership, equivalent to one vote typically in the company, and you get access to like assets and dividends. That's what Class A common stock is. Then there's also Class B stocks, which is preferred stocks. These have a little bit more benefits. Basically, what they still entitle you to like one vote per share that you own. But typically, like owners might receive $2 in dividends as opposed to $1 in dividends as a Class A shareholder gets. So just different, priority distribution. Like if, something was happening to the company, preferred stockholders get paid first before common stockholders, little things like that. So it has a little bit more benefits to it than Class A common stocks. They're not typically traded on the stock market, um, but that does exist. That type of stock does exist. Then there's Class C stocks. These are typically, the executive stocks. Usually, a share of that might be equivalent to 100 votes of common stock. They still receive access to things like dividends and assets in a company. They just have more power attached to them, Class C stocks, and those typically aren't traded as well too. Okay. Um, Now, within owning those shares, kind of understand that there's few things that come with owning that too that you get. Like as a shareholder, you might have access to company proxy meetings where they, talk about things with the company, and more. I mean, it just depends on how much you own. Like for example, when I owned, like 500 shares of Ford, when I go to a Ford dealership, I get as an owner of 500 shares or more, I got discounts on my vehicles that I purchased. So it's just little things like that as a shareholder that you're entitled to sometimes. But typically, it's things like proxy meetings and voting power is what you get. There's also things like deferred share dividends as well too. That's kind of like the opposite of preferred share dividends. So that's just kind of something to keep in mind. You don't have like voting rights and stuff like that. It's just there. So those are the different types of stocks that exist. Again, we won't get into too much detail of that right now. What we want to focus on is the basics, and that is just kind of talking about the common stocks where you own one share of a stock and you own part of a company. That's what a stock is. Okay. Now, common terms in trading. These are the terms that you'll hear pretty often in the markets, okay, or when discussing the stock market with other traders. You hear things like long. Someone will say, I'm going long on this stock or long on this company. That basically means that they assume that the price of the company or stock is going to go up, okay? Then you hear somebody say going short. It means they think the company is going to go down. They think it's, overvalued, worth way too much than, what it's showing, and and the price is going to go down on it. You might have seen movies like The Big Short, where they, shorted the U.S. economy, expected it to go down like it did. So that's what that means. Then you'll hear bid, ask, and spread. Now, the ask is what a person is willing to buy the price of the stock at. A bid is what they're willing to sell the price of the stock at. The difference in between the two is called the spread. So let me sort of give you an example. That way it'll be a little bit more clear for you. Let's say you got one stock that's, let me just draw here, it might be a little bit, let me just type it here. Let's say if you got a stock that's $5.20 on the ask. Then on the bid side, you got someone wanting to sell it for $5.30. This is just an example. The difference in between the two is what? 10 cents, right? So there is a 10-cent spread between the amount that someone is willing to buy it and the amount that someone is willing to sell it. Okay? That's what the spread is. Bid-ask spread. Pretty simple there. Got it pretty much pictured out right there for you as well too. Then there's commissions. Commissions typically refer to the amount that a broker gets paid for executing your orders. Some brokers are commission free, some of them aren't. It varies from broker to broker, but you'll hear that sometimes people talk about the commissions for brokers. Okay. Now liquidity. Liquidity refers to the ability to cash out on your stocks or assets that you own, pretty much. So when you hear something being liquid, that means that you're able to quickly execute that order and get it done. Someone says, hey, this stock is very, very liquid. That means it's easy to get the orders placed because a lot of people, or there's a lot of times where it's being traded, or people asking for the price. It's very liquid. It's very easy to cash out in that stock. Then there's volume. Volume refers to the amount of orders being placed on a particular stock. Sometimes you hear, oh, there's low volume on this stock, or there's a lot of volume on this stock for this particular day. So that basically just means that there's not a lot of buying and selling going on at different prices for that stock. So liquidity and volume kind of goes hand in hand. The more volume that's traded in the stock, the more liquid it is. The less volume that's being traded with the stock, the more illiquid it is. Okay, so kind of keep that in mind. Typically, when your spread is smaller, it's a lot more volume going on because a lot more people are trying to get in and get out of the stock, and the stock is very liquid. Bigger spread, bigger difference between the ask and the sell price means that the stock is not liquid. It's harder to get your order filled because the amount of money people want to spend and sell it for are too great for the orders to get filled. So volume is when it happens a lot, and tradings are happening quite often, makes it a high volume stock. So that's kind of the difference between the two. All right. Volatility. Volatility refers to the change in the price of the stock or security itself too. Like you hear a lot of times people might say that crypto is risky because it's very volatile. That just means that it changes price frequently in a big amount. It could be, you know, this many dollars one day, then that many dollars another day, and within the hour, within the time frame. It has a very, fluctuating price. Some people like volatility, some people don't. Varies from person to person. Then there's PDT. You'll hear people talk about the PDT rule or be subject to the pattern day trade rule. What the pattern day trade rule, and this is just for U.S. Traders, investors, or whatever you want to refer to yourself as. Traders and investors are different. We're not going to go over that. But PDT, the pattern day trade rule, was implemented by the SEC. I think it was back in like 2002 or something like that. I can't remember the year, but it was implemented by the SEC to prevent people with small accounts from being able to trade more than they want. I'm not going to get into the semantics and politics on that, but understand it's a rule that exists that people who have accounts that are $25,000 or less can only trade 3 times within a 5-day period. Okay, so if you had $24,999 in your account and you tried to trade more than 3 times within a 5-day period, the same day, you'll be hit with a pattern day trade rule violation, which, for broker to brokers, you're subject to different things. But you'll hear that often in the market. There's ways to get around that and things like that. We're not going to discuss that. That's for another video. Um, but yeah, the pattern day trade rule is for anybody's account who has $25,000 or less can only do a day trade, which is buying and selling a security within the same day, same business day, within a 5-day period. You can't do it no more than 3 times. Puts a limit on how many times you can day trade. All right, so that's that. All right, those are your common terms. Now, get this question quite a bit too. How many stocks are in the stock market? The short answer to that, of course, is thousands, guys. It's not important to really know that, but it's good to know that. So I think as of right now, there's like 38, let me see, 38, oh, 3,812 stocks in the stock market as of 2022. The most there's ever been in the stock market, the U.S. stock market. U.S. stock market. There's also like Hong Kong markets and London exchanges, different markets. So I'm talking about the U.S. market because that's where I'm trading at. 3,812 stocks available. Most that was ever there was in 1998, 7,562. I was 19 years old. Anyways, now why has the amount of stocks decreased since then? I mean, it's a variety of things. It could be, sometimes that, companies get delisted, companies go bankrupt, companies, do mergers. There's also nowadays a lot of SPACs out there, special purpose companies. So many different reasons. So just because the stock is in or companies in the stock market doesn't mean this could be there forever. Okay, so just kind of know that. That's good to know as a trader and investor. Um, those different things. So yes, a lot of stocks out there. So don't be worried about, oh, I won't find the right stock that's for me. As a trader or investor, trust me, you'll have your options. But that's good to know that there's a lot of stocks out there. So don't overwhelm yourself either. You don't want to do that. Now that we know there's a lot of stocks out there, well, what kind of stocks are there? Stocks themselves, those securities that you own, invest in, etc., they're typically broken down into, two different types, just in general, just generalization purposes. Um, there's sectors, and then there's also market caps that they break them down into. So these are the different sectors that are available when it comes to stocks. There's energy stocks, so there's an energy sector. There's materials, there's industrials, utilities, healthcare, financials, consumer discretionary, consumer staples, information technology, communication services, and real estate. All these are pretty much different. So let's say, for example, like with the energy sector, you got companies like, ExxonMobil with the New York Stock Exchange. You got Chevron. Those are energy type companies. Okay. Then there's also materials. In the materials sector, I think you got companies like DuPont, Sherwin-Williams. Those are big companies in the materials sector. Industrials, you got like Boeing. They're very popular. Union Pacific, I think it's like popular with industrials too. As far as utilities go, Duke Energy. I know I used to have Duke Energy. um, there's is it AEP, American Electric Power. So those are some, utility companies that specialize in just that. I wonder if SDG&E is there too. But anyways, healthcare sector, you got Johnson and Johnson, uh, United Healthcare Corp. I don't know if oh, Kaiser is in there as well too. Maybe Moderna and them. I don't know. But anyways, you guys healthcare stocks. Those are some examples. The financial sector, you'll have like big banks, JP Morgan Chase. I think Berkshire Hathaway as well too. Uh, yeah, I mean you got financial like that, financial sectors like that. There's consumer discretionary, which is probably popular ones that you guys know, like Amazon, McDonald's, companies like that. There's consumer staples sector. Um, they basically like meet the needs of companies, current financial, you know, condition. So you got companies like, Coca-Cola, Procter and Gamble. Um, they just provide goods and services for, you know, consumers. Those are popular ones there. Information technology, you got like Apple, Microsoft, all the ones you guys probably know. Um, their information technology sector. Then there's the communication sector, Facebook, Google, Alphabet, um, those type of companies. There's real estate, which is like, a big one as well too. So you have like American Tower, Simon Property Group. Those are some major ones. And these are all just companies I'm kind of listing like off the moly fuel and stuff like that. But those are the sectors and companies that fall in the sectors. Again, there's thousands of them in each one of them. I'm just kind of giving you some examples so you can kind of relate to. You might know companies that fit that sector as well too. Okay, so that's one section that stocks are broken into as far as different types and categories go. They're also separated by what's called market cap. Market cap means the value of the company. Okay, um, and they're broken into different capitalization size. Excuse me. So market cap. I'll break down the definition of that a little bit later. But anyways, you got your mega caps, which are companies that are valued at 300 billion or more. Then you have your large cap companies that are valued at 10 billion or more. Your mid cap companies, which are 2 billion to 10 billion. Small cap companies, 300 million to 2 billion. Micro caps, which are 5 or 50 million to 300 million. Nano caps, which are 50 million. And then you got penny stocks, which are, stocks like $5 or less. And they fall below a certain, price necessarily. Not necessarily market cap, but a certain price. Because there could be, a big market cap company that's like trading at like $3.50 a share. Just because the price is so cheap doesn't mean it's a low value company, because the market cap could be a lot. Companies like SNDL and all the NAKD, all those companies. But yeah, so that's pretty much the sectors. That's pretty much the categories they're broken down into, just in general. You could break them down other ways as well too, but we're not going to get into all that. Just kind of know that stocks are, referred to like that sometimes: market caps and sectors. So, how is the stock price determined? This is pretty much where we go into the market cap and all that good stuff. So let's kind of take a step back. The price of the stock is simply to put determined by supply and demand. I'm not going to get into a whole economics course for you guys on supply and demand, but generally it's going to be based on the number of outstanding shares times the market price, which is what people are willing to pay for it, the demand. The supply is the number of shares that are available to trade. Okay? So, when the supply sees the demand, prices fall. Demand exceeds supply, prices rise. Okay? Kind of like in this picture here is kind of illustrated. Kind of the best way to read this. The demand falls, supply rises, the prices go down. Demand rises, supply falls, price is going to go up. It's simple economics. I don't think it can kind of get any easier than that. Because most companies, until they decide to issue more shares of stock to raise money and put into the company, they're going to have a limited number of shares that they can give out to the public. So let's say, for example, to kind of keep it simplistic, let me give you a decent illustration. Sorry, I'm just trying to pull this up here for you. Let's clear this out. So let's say we have company XYZ, right? They started the company came out, they decided to go to the public, hey, we want to give out shares to raise money to grow the company. We only have, I'm going to keep it simple. Let's just say we have 100 shares available. We're letting the world know we have 100 shares available. You can buy this company at $5 a share, okay? And be part owner of the company because we want to raise this money to help our company grow. What you're going to do to find out the value of that company, you're gonna look at the market cap. The market cap refers to the value of the company and is calculated by multiplying the share price. In this instance, it's $5 times, make this a little bigger, the number of shares available to buy. And this one is 100. So the market cap here would be what? $500. Now let's say you got all these people willing to buy it for $500 or $5 a share, right? So naturally they buy it. Now other buyers come in and they say, hey, I want some shares in this company. You only bought it for $5. I'll give you $10 for it. This thing just doubled in price because the company is so great. Now what your market cap is? Twice as much, $1,000. Pretty simple. So that's how the stock price is determined. Supply and demand, buyers and sellers, what they're willing to pay for the stock. And you'll see there's companies that have massive market capitalization, like Apple. It's going on 2 trillion, probably hit 3 trillion, I think. um, other companies like Microsoft, Saudi, Amazon, Alphabet, all these companies, even cryptos in there. I mean, they even have Bitcoin has a market cap as well too. So every security, excuse me, has some type of market capitalization to how much supply there is, and then you have the public giving the demand of how much they want to pay for it. Okay, so that's pretty much how that works. That is how, ladies and gentlemen, stock price is determined. All right, let's get ready to take a little break because I know that's a lot of information for you guys who are beginning, and let's recap what we've learned here. First and foremost, what did we learn? What a stock is. A stock is ownership of a company that's equivalent to how many shares you have, which is how much ownership you have. Okay. Common terms in the stock market. We went over all those long, shorts, the PDT, volume, liquidity, bid, spread, asks, all that good stuff. We went over those terms, so get used to hearing those. The different stock types, we went over those, how they're broken down into sectors and how they're broken down by market capitalization, aka value. Okay. And then we talked about how to calculate the stock price. All right, which is of course the market capitalization times the price of the shares. That's how you find the price of the stock. All right. So go ahead, take a quick little break. Gather your thoughts. If you need to, pause the video right here and come right back. And we're going to get into some more stock market for beginners 101. All right, guys, we are back at it here. So we're going to move on to the next section. So here's kind of the big question here. How do you buy and sell a stock? Well, there's actually, a few different ways to do it. The easiest and most typical route is basically going through your broker and placing an order to buy the stock that you want to buy. Pretty simple process as I break it down here for you. You're going to know exactly how to do that and what takes place when that's happening. Okay. Now understand, there is a lot of different brokers out there that you can sign up with. Um, the difference in between the brokers varies. There's no really, you know, for say of one being better than the other. Just depends on what you want to do. That's like saying, you want to go get a burger. I mean, you can go to McDonald's, you can go to Burger King, Wendy's, whatever. It just depends on which one you like. And they all vary. It might be one reason why you like one or the other. It could be convenience. One's right down the street. It could be you just like the way that one tastes, you know, vice versa. So understand that there's a lot of different brokers out there. But either way, you would sign up with one in order to execute, your order and buy the stock that you want to buy. So mainly the different type of brokers that there are. There's online discounted brokers that you may hear a lot, such as like Robinhood, Webull, Moomoo. They offer no commissions on, buying and purchasing stock. Those are like really popular ones. Then you have offshore brokers like Capital Markets Elite Group, used to be SureTrader. I mean, there's still other ones that are out there, not many, but offshore brokers basically mean they're not subject to, U.S. Market regulation. Um, so there's those type of brokers. Then you have full service brokers, such as like E-Trade. Um, I believe TD Ameritrade, Thinkorswim is a full service broker as well. There's also Charles Schwab, um, you know, Merrill Lynch. I mean, there's a couple of different full service brokers out there. And then you have also like direct access platforms like Centerpoint Security, Speed Trader, which are for like day traders who need to execute orders pretty quickly. And those are pretty much kind of the different type of brokers that exist. With full service brokers, they have, the ability to have like, 401ks and other different types of financial products other than just, buying and investing in stocks. Um, that's what makes them a full service broker. They're pretty much there to meet most of your financial needs for not just trading stocks. And then the online discounted brokers like Robinhood, Webull, and them, they focus basically on stocks and crypto when it comes to that. They might have other little financial products available, but not as many as full service brokers do. So that's kind of the difference in between the two. As far as like the features and stuff like that varies, we would be here all day talking about that. I have a whole separate video on and a whole separate list of brokers throughout the courses and stuff like that. So we won't spend too much time on that. But understand, in order to buy a stock, that is how you would pretty much execute, you know, getting those shares. And we're talking about Class A common stocks. Okay, we're not talking about any other classes and being an, uh, early investor and getting preferred shares and things like that. We're talking about just you wanting to buy a stock in a company that you like. All right. So that's pretty much how the first step would be. You signing up with the company and being able to purchase the stock. All right. Now, how does the process work when you buy a stock? Basically, once you sign up with your broker, you're going to then fill out that information, your name, address, et cetera, for, legal and tax purposes. Then you're going to find a stock that you want to buy, whether it be, let's say, Apple, Amazon, or whatever. You're going to, be able to open up your brokerage's platform. You're going to search for that company name, and then you'll be able to place an order to buy that stock at a certain amount, whether if you want to buy it at the amount that it's at now or amount that you feel comfortable with, you can place an order for either or. And then once you place that order and your order gets filled slash executed, you now are part owner of that company. Okay. So that's the easiest way to do it. Sign up, search for the stock you want, place the order, let it get filled at the price you want it. Now you are owner of a stock, partial owner of a company. Pretty simple there. All right. So understand that, some platforms, in brokerages will allow you to get your orders executed directly with the exchange. We'll go into detail on the exchanges and stuff like that a little bit more here in a second, okay? Um, but that's you know sometimes coming at a price, being able to do that. So let's take a look at what I'm talking about. So when it comes to buying your stock, you have you, then you have the broker, which is who you sign up with to fill your order. And what they do is they place that order onto the exchange, the stock exchange, to get filled. All right. Then on the other side of that, that you don't see, is that you have another broker sometimes. And you have other people who are placing their order. That's where you have buyers and sellers. All the buyers and sellers come together on the exchange to buy and sell stocks. Now, understand there's different types of exchanges. There's quite a bit of them. There's the New York Stock Exchange, American Stock Exchange, there's the NASDAQ. All these exchanges vary, and you know, it's not saying that one's better than the other. Certain types of stocks are listed on certain types of exchanges, and that pretty much would determine where your orders are routed to get executed. Um, this is just the process to kind of know. You won't really have to deal with any of that. The market makers and stuff like that deal with that. You're basically seeing yourself place the order for the shares and how you want to purchase them. You send it to your broker. Your broker sends that order to the market makers who executes that order on the stock exchange. Okay. Um, and that's how that works. As far as like the different stock exchanges go, uh, like I said, it's only it's not too many of them, but it's quite a bit. There's like the New York Stock Exchange, the NASDAQ, London Stock Exchange, American Stock Exchange, Amex. There's like Tokyo Stock Exchange. There's also OTC markets that are, deal with penny stocks, pink sheets markets. There's New York Stock Exchange, ARCA, New York Stock Exchange, Chicago. So a lot of times when you see orders being placed, if you're looking at things like level 2, you'll see orders in there for buying a share at $3.50 going to NYSE. That means it's going to the New York Stock Exchange, and et cetera, et cetera. So you'll see that. Now, what I wanted to make a little note as well too for you guys is that sometimes, platforms like Speed Trader, for example, eliminates the brokers themselves, and the orders go straight to the exchange. That's one of the benefits for people who are typically day traders. Their orders are getting executed faster and filled faster than other people who might trade on platforms like Robinhood or Webull. And I won't really get into the semantics of this. I'll actually probably put this in another video as far as how orders are processed. Um, but understand that's the general concept of how it's done. You, the buyer, send your order to the stockbroker, who sends it then to the exchange, who is also looking at, who pretty much in the exchange is, the market makers are executing those orders, who are also seeing other stockbrokers come from people who are selling their stock, put their orders in to the stock exchange as well. They're matching those up and filling them as quickly as they can. Computers do most of that now. So that's how that works. All right. Pretty simple. Now let's talk about placing the order when you want to place the order with your stockbroker. There's different order types that are available. To keep things simplistic, like I said, I'm going to just touch over the most common 3. There are more advanced orders, but we're going to focus on these right now. So first and foremost, there is the market order. So this is where you buy or sell a stock at the current price. You would use this in an instance you are trying to get your order done as quickly as possible. You don't care what the price is. You don't care anything about it. You just want to get it. Okay. Has its pros and cons, especially depending on what you're doing. And we'll talk about the pros and cons of each of these orders here in a second. Okay. So that's what the market order is. You're filling you place the order to buy the stock at whatever the market price is, or sell the stock at whatever the market price is right now. There's a limit order. Now, limit order means that you want to buy the stock at a specific price. That means if you've seen Apple and it's $90 a share and you want to buy it for $85 a share, you place your order for $85 a share. Your order won't get filled until the stock price reaches $85 a share. Okay. Or if you want to sell it at that price. But let's say if your order that you wanted to put it in is higher than you know, what you're currently wanting to get it for, it'll get filled at the best price. It's kind of, a little caveat to that. So let's say, for example, you want to buy Apple at $110 a share because that's how much you think it's worth. But something happened and it's all of a sudden, at $85 a share, you're going to get filled at $85 a share. So you basically just got a discount. Same thing with selling it. Let's say if you wanted to sell it at, $90 a share, but the current stock price is at $150 a share, you're going to get filled at $150 a share. That's kind of how that works. Okay. So then there's a stop order. Stop orders allow you to buy or sell the price, buy and sell the stock at the current price after a specific price point is reached. Okay. So let's say if you place a stop order, let's say if you wanted to buy, a stock and you place a stop order to not buy it once it went down to, $65 a share, then it'll get stopped out at that point. So let's say $6 a share price is the lowest that you want, right? That's your stop order. And the price is currently at $70 a share. Once it hits 65, it's done. And vice versa if you're selling. Okay. So that's pretty much how the stop orders laws work. The stop orders work. Okay. It basically saves your butt from a stock tanking. Now, let's kind of put this in perspective. Let's say and talk about the overall pros and cons of each one of them. Market orders are good for when a stock is very volatile and it's moving fast and you just want to get in because you like the company, you had good news and all that good stuff. You want to just get in. The only problem with that is you might be overpaying, for the stock. You're not going to get the best price for the stock. You're just, you could be subject to getting it at a ridiculous price. Okay, happens sometimes. So understand that that's the risk with the market order. With the limit order, it's kind of the opposite. You're kind of risking on missing out of getting the actual stock. Because let's say if wanted to get in the stock and it was at $14 a share, and you're like, okay, I want to get it for $14 a share. The moment you place your order, now it's all of a sudden at $17 a share. And the stock just keeps going up and up and up. Your order never gets filled because the stock never came back down. Okay. And then same thing with the stop orders. The thing with that is you could get stopped out of your order and the stock actually goes the way that you want it to go. So let's say if you bought a stock at $70 a share, you put a stop order in to cash you out if the stock goes below $65 a share. The stock could go to $62 a share, but then it goes right back up to $100 a share. Now you've missed out on that because at the point that you brought it, it went down, hit your stop loss, and then went right back up. Happens. So those are just kind of the limits on, like the basic order types that you would put in. Now, again, it can get a little bit more advanced. There are more different order types, but I'm not going to go over that here. Usually that's for like, advanced traders, stuff like that. There's things like OCO orders, one cancels the other, and different types of orders that you can use, iceberg orders and stuff like that, but we're not going to cover all that right now. So these are pretty much the three order types that are available. So when you go to your broker to buy your stock, you're going to have to place either a limit order, a market order, or, a stop order. Generally, those are the three that you're doing. Now, of those orders, they will either have to be good for the day or good till cancel. Sometimes they'll be good for a certain amount of days, like 60 days or 90 days. So let me give you an example. Market order made that's going to be good for the day means it has to the end of the day to get filled. A limit order that's good for the day has to the end of the day to get filled. If it doesn't hit that price by the end of the trading period, at the end of the day, it's done. Quick little note, trading hours are from 9:30 Eastern time to 4 o'clock Eastern time. Okay. You have after hours and you have pre-market hours as well too, which is before then. So that's just something to kind of note. I meant to mention that earlier, but a lot of people ask me, especially in the beginning, well, when do I have time to trade? And this is just US markets. The reason why I didn't really generally put it in there is because obviously different hours around the world, different markets are open, all right, or closed. So that's just why I kind of didn't put that in there. But if you needed to know, from um, 1 a.m. Pacific time, which is 4 a.m. Eastern time, 4 a.m. Eastern time till 9:30 is pre-market hours. From 9:30 until 4 p.m. is the day trading hours, and then after hours, which is from 4 to 8:30, is after hours time. So that's pretty much the market hours. You got a whole 16 hours a day to trade. But anyways, back to the order types. So you have the good till canceled, which means that market order or limit order or stop order will stay in there indefinitely until it is filled, no matter what the price is. It's just going to stay there until it's actually filled. Then you have the good for the day orders, which means it's good for the end of the day, that specific day. And then you have ones that are good for 60 days or 90 days, which means you have 90 days or 60 days to fill that order at that price if it gets there. So that's pretty much how the order types work. Hopefully that's simple enough. All right, so those are your order types. Now let's kind of recap here what we learned on how to buy the stock. So we know now how to buy the stock. We know that you sign up with a broker, input in your information, load up your bank account. Now you have money in there to buy stock. You will then place an order with the broker, and the broker is going to execute that order on the exchange, and you are now an owner. It's pretty simple. It's just clicking in a button, punching a number, and let it do its thing. We now know what brokers do. We know that the brokers take your orders and they execute them on exchanges with the market makers. Okay. We know how the process of buying and selling a stock goes. We know there's have to be buyers and there have to be sellers, and they come together on the exchange to fill orders at their desired price. This is where the supply and demand comes from. This is how a stock price is determined, by what us, the market, determines. All right. And then we understand what order types that are available to be placed. We know we can do market orders, which are made by basically whatever the market price is. We know we have limit orders where we can decide what price we want to pay and wait for the orders to get filled. And then we know we have stop orders where we can protect ourselves from losing all our money, but eventually can also have the ability to lose out on a lot of money if it gets filled and then goes back up. So that's kind of how that works. So play around with orders and understanding how brokers is. This was a quick little tidbit of information, kind of a lot of information, but we understand that now. We also learned too what the market hours are when it comes to trading and the ability to do so, US markets. All right, so take a quick break, recap that, let that settle in. We're going to come back to it and jump into the next section. All right, we are back. Sorry, I had to give me a little snack, but let's get right back into it now that we've recapped on the process of buying a stock. So now that we know how the stock is bought and the process it goes through, how do we know what stock to buy? How do we find stocks in order to become a good investor or a good trader? Okay, so there's a few ways you could do it. One, you can already know companies that you want to buy that you're interested in. What I tell a lot of my friends and family and stuff like that is think about things that you use on a daily basis, or look at some of the stuff you might use on a daily basis. For example, your phone. You might want to invest in an Apple iPhone. You might want to invest in Samsung. So you're going to look for that company, go find their stocks, find the company, and see if that's one you want to invest in. If you use toothpaste, go look at Procter and Gamble. things that you do on a daily basis. Those are good ideas to get. Like, hey, I use this on a daily basis. I might want to invest in this company. Clearly, I have a good use for them. They have some value. I might want to go either buy shares or be an owner in that company for whatever reason may be. That's a good place to start. Quick way to come up with ideas. Another way is you can look at the news. Many people do that. There's news like Market Watch, CNBC, or just regular news, and you might hear things about companies that may exist on the stock exchange that might have something great coming up or a great product they just released, and you might say to yourself, "Hey, I'm interested in owning some of the shares in that company." That's a good way to find a stock to buy. Another way, which is a lot of way that traders use, or even people that are interested, but mostly, a lot of traders use this, is you can scan for stocks to buy. Um, you can use a scanner or a filter to be able to do so. So one good resource that many people use, um, and I'll pull it up here for you guys actually so you can kind of take a look at it, is finviz.com, where they have a really good scanner. And I talk about this a lot on the channel for people, who aren't familiar with it. FinViz is a great tool that lists pretty much every company that's out there. And you can, click on the screener here and you can search for companies based on different criteria that you might like. You can sort by different fundamentals, different technicals, or all of it together. Let's say if you want to find stocks that are within your price range, you might want to find a stock that's under $5. They'll give you all the stocks that are under $5. You might want to have one, that is in USA only. They'll pull out all the stocks that are in the USA. You might want, something that has a good target price, a lot of value. I mean, there's a lot of different things you can sort for. Um, but just understand, that's a good way to find stocks that might interest you. Then what you would basically do is click on the stock. You can open it up. It'll give you a lot of information about the stock. Let's, for example, take a look at this one. You'll see tons and tons of information here. Okay. So that's a good way to kind of scan for stocks and just see if there's something there that might pique your interest. Close that out. So that's a good way to find stocks. Okay. Now that you find a stock that might interest you, you might be asking yourself, well, now that I found a stock, how do I analyze it? How do I know if it's a good stock? Well, it's going to be really up to you. This is what's called due diligence. When doing your due diligence, you got to ask yourself, now that you found a company that you want to either invest in or trade in, how do you want to approach this? If you found a company that you think is going to grow because of a new product, do you think the company is a good company, period? Do you think it's a bad company? Do you want to short it? You can profit on both ends, thinking the company is good or thinking the company is bad and expecting the price to go up or go down, however you want. And we'll talk about all that shortly, how you profit from doing that in a second. But just understand that once you find a stock that you're interested in, you need to perform some type of analysis. Okay. And then your analysis is going to be based on what you think or what you predict is going to happen to the stock. So understand there's mainly two types of analysis you can do. Now that we, form the hypothesis of the stock that we want to look at, um, the two types of analysis you can do, and they can get very, very detailed. So we're not going to go into too much detail on it. We're just going to touch on them just a little bit to kind of get a brief understanding of them. I have another video. I'll put a link in the description below on how to do one of them. And the other one we pretty much do every day on the channel when we're reviewing, stocks and trades that we make throughout the day. So first one is fundamental analysis. Okay. This is the one I'll put a link to a video in. I have a whole, another long video on how I do fundamental analysis and what I look for. You guys can take a look at that to get yourself an idea, but there's no right or wrong way to do fundamental analysis. It's just giving you a, brief understanding of how I do it. I guess there is kind of a wrong way, but it'd be really hard to do it wrong. But anyways, fundamental analysis is basically you looking at the numbers of the company. Again, there's plenty of ways to do this. not going to go into details on how to do it, but when you're doing fundamental analysis, you're looking at the quantitative portions of a company. Okay. Um, you also want to kind of combine the quality of the company too, to a certain extent. Um, that's going to be up to you. So what I mean between the two, when you're looking at the quality of a company doing fundamental analysis, you're looking at things like, you know, is this a good disruption in technology that's going to benefit and have a lot of, potential to get bigger? Is it going to be things like management change? As the manager, have they changed CEOs and now this new CEO is coming and is going to do great things for the company? That's a qualitative analysis that you can't put a number on. Okay. It has, has something happened recently to destroy the reputation, the goodwill of the company? You can't put any kind of measurement on that. That's a quality, a quality analysis that you want to do, a quality analyzation that you want to do on researching a stock and the fundamentals. Okay, so you have the qualitative. Now you have the quantitative, which is the numbers. You can look at the actual numbers. There's plenty of ways to look at the numbers on the company. Again, I walk you through how to do that in the fundamentals, video. But basically, you're going to be looking at things like the assets, the liabilities, the revenue, the cash, the PE ratio, et cetera, things like that. Again, I'm not going to get into too much detail into it, but a fundamental analysis requires qualitative and quantitative analysis, looking at numbers and quality of a company, so you can come up with an hypothesis of whether you think it's going to be good or go bad, however you want. Excuse me. Now, and you can, look at things like matrices, like momentum, net income, earnings coming out. So many different ways to do quantitative analysis, especially when it comes to the fundamentals. All right. Now you also have technical analysis. What is technical analysis? Technical analysis is basically reviewing, price charts, price movement over specific periods of time. Okay. You're looking at the behavior of the stock and the way it's performing in the market. That is technical analysis in a nutshell. Again, not going to go into too much detail over that, but we'll touch on it a little bit. And this is, pretty much something, technical analysis is what we pretty much do every day as day traders. Okay. Swing traders do it too. I mean, pretty much all traders do it. It's just some do it more often than the others. All right. um, so when it comes to doing due diligence, you're broken down into a category of when and how you do your due diligence. Okay. Um, and different traders perform different analysis and due diligence. Okay. For example, scalpers use technical analysis. People who get in and out of the stock really quickly, they don't care about, you know, revenue growth. They don't care that they just, hit their earnings that they were expected to do. They don't care that the company has grown 100% year over year for the last 5 years. That doesn't matter to them. They're scalpers. They're looking at the technicals. They're looking at the price movement and basing their trades off of that. Same thing for day traders. We're looking at things like that. Sometimes day traders might use, information from fundamental analysis to be able to, you know, have reason to get in and out of a stock, but for the most part, they don't really care too much on what's going on. They might use it as a tool to make a trade, but the details of it, minute, irrelevant, not worried about it. They're looking at price, chart, and all that stuff so that they can predict the movement of the stock. Now, swing traders are unique as well too. Oh, excuse me. So swing traders are going to be looking at kind of both fundamentals and technicals. And I'll break down what each trader is here in a second. Swing traders look at a combination of technical analysis and fundamental analysis to be able to predict, the pricing of stock and profit from there. Position traders don't really care they care very little to next to nothing about technical analysis. Position traders are looking at the value of companies, the fundamentals. They want to know, is this company, performing like it should? Or is it overvalued and needs to go down in price? That's what they're looking at. They're looking at the numbers. They're looking at the quality. They could care less about what the price was back in, '06, blah, blah, blah. Position traders or value investors, long-term traders. Okay. So let's kind of break down the difference between the two or the four. The scalper here, again, is considered, a day trader as well too. They just get in and out, 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 in and out as the price is movement, and they get their profits there. Day traders are people who get in and out of the stock the same day, like myself. Um, just get in the stock, make a trade, get out. Pretty simple. Swing traders are traders who hold their positions overnight for longer periods of time. They might hold it for a day, a week, a month, sometimes quarterly. They A swing trader never typically holds it more than a year. I like to say 6 months at the most when I'm swing trading. We're not going to get into semantics of how I trade, but in general, a swing trader is not holding a position longer than a year, but they're not going to get out of position, as quickly as a day. They're looking at time frames as like 4 hours, the daily, the weekly charts. Those are the ones that they're looking at when they're performing their technical analysis. Okay. And then they're also looking at, news and things like that are happening to companies and how they're performing. So they're looking at a little bit of both. Swing traders, um, you know, do more research probably than most. Position traders, value investors are only looking at it probably every now and then. The fundamentals of the company. They're looking at the quarterly sales. They're looking at projections. They're taking a look at analyst reviews, and public sentiment towards a company. That's pretty much how it works for position traders or value investors. So those are the difference between the two. Mainly, it's the time frames as far as which they are in and out of the positions of stocks in the stock market, and it varies from person to person. As far as which one is best, again, that varies from person to person too. Um, if you're starting out, and I'll reiterate this later on, if you're starting out, I suggest starting out as a position or value trader, just so you can get a practice and a good foundation. In fact, being these types of traders, it goes the way this is set up. It looks like it's from hardest to easiest. Very difficult to be a scalper and be successful. Very difficult to be a day trader and be successful. Most people, will generally start out swing trading, and then position or value trading is really easy to do for most people because you have ample time to do research and things like that. So that's kind of how that works. Now, times to buy the stock, and we're going to get into this here at the next break. But basically, now that we know how to buy a stock, we know how the process works. We have a broker and everything like that. We want to know, well, when's now you found a company you want to invest in. Well, when's the best time for you to invest or trade? When to enter, when to exit. Knowing this is very important in the market and being successful because you need to be able to figure out how to trade the stock you want to trade, when you want to trade it, because it's going to vary from time to time. Like, for example, you probably wouldn't want to short or bet against a stock when they're about to release earnings and you know that they've sold out in stores for, X amount of dollars and all that good stuff, because the stock is going to rise and you're going to lose money as because you thought it was going to go down, but it's going up, and vice versa. Um, so keep that in mind. Knowing when to buy a stock and having, the ability to analyze when the best time for you to buy a stock is going to be very crucial for you as a trader and investor. Okay. So let's kind of recap here what we talked about. We discussed how to search for stocks. Um, so have an idea, either companies you use, companies you heard of on the news, or just go search and scan for, a company that you want. We talked about how to perform stock analysis. We know that there's fundamental analysis where you look at the numbers and the quality of a company. Then we know there's technical analysis where you're going to be looking at, price patterns and charts of the company. Okay. And then we discussed that the timing, good times and bad times to buy or sell a stock. You want to, make sure you have your timing correctly as well too, because that helps you become a more profitable or a better investor or trader. All right. So let's take a quick break here. Let all that sink in. We're going to circle back to this and get into some more. All right, guys, we are back and we are going to continue with the stock market for beginners. All right. So let's go ahead and get into it. So we just kind of talked about, when is a good time to buy and sell a stock, right? Now, understand, you do your analysis, do your research and stuff like that. The time to buy the stock is going to be dependent upon your trading strategy and what you want or assume is going to happen to the company, security, or whatever you want to call it. What you think is going to happen is going to be very, very important. You're almost like a scientist, okay? You're doing your research, and based on what you know or believe is going to happen, you want to be able to profit off of that, okay? That's the goal, excuse me. This is basically your trading strategy. There are tons of different trading strategies, okay? And we'll touch on a couple of them. I'm not going to touch on all of them because, there's so many in there. I do so many different videos for that. So we're just going to focus on a few right here because you're just beginners. You need to get just the most common ones that most people talk about, okay? So here are a few common trading strategies that people use. One is the dollar cost averaging strategy. A lot of times you'll hear people say, oh, buy the dip or buy low and sell high. Dollar cost averaging is probably one of the most effective ways, especially as like a value investor, a long-term investor, or really as any kind of trader too, to be profitable in the market. I personally, I'm a big fan of dollar cost averaging. That's kind of like one of the first ways I was able to become profitable in the market was doing that. And this was back before I knew about actual day trading and scalping and stuff like that. I pretty much just always assumed you buy a stock and you just hope for the company to grow, and you just wait it out. But you can dollar cost average on any time frame really, as any type of trader. But dollar cost averaging, let me kind of break that down for you too and explain exactly how that works. I'll pull this up here. So with dollar cost averaging, maybe I should draw it this time just to kind of be funny. Sorry. So dollar cost averaging, let's not do that. Let's do text. It was kind of big. So dollar cost averaging is pretty simple. Basically, let's say, I'll make the font a little bit bigger here so you can see it better. Let's say if you have stock XYZ company, right? And let's say on, January 1st, you bought it, make this bigger. You bought it at, I don't know, $50 a share, right? Great. And then let's say, in between that time, the stock has gone up and gone down, is fluctuated, because it was very volatile. So let's say it's gone up to like $75 a share and then went back down to like, and went down to like $10 a share, vice versa, blah, 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 whatever you want, doesn't matter. So you bought it at $50 a share. Here it is, come, I don't know, February 1st. You noticed, or you checked the market and you looked at, you looked at the price of the stock at the moment, and it was then at that point trading for, let's say $20 a share. For one reason or another, the stock is down at this point in time. There's, no particular reason why you don't, like, let's just say they had like, less than better sales that they were expecting to get. I'm just giving you guys a hypothesis here to kind of give you the picture. And the stock price went down to $20 a share, but you still think it's a good company. You think the fundamentals are great. They had one, minor slip up in the fourth quarter because I don't know, another company like Amazon or something like that took away from all their sales from a new online product, whatever you want to make the reason to be at. You did your fundamental analysis and you found out, hey, this is still a good company. I still believe in them. I personally think they can still go higher than $50 a share. Plus, they got this new thing coming out. It's going to be great. Now you see this as an opportunity to buy some more shares at a lower price. What that is going to do is bring your cost basis down as far as what you had to spend on the stock. So instead of having to buy it at $50 a share that you bought it in January, now you can buy it at a discount at $20 a share. So what's going to happen there is, let's just say you bought 5 shares at $50 at the point that you did, right? At that point, you've spent $250 on that stock. Now, come February 1st, you're like, hey, I got some more money in my pocket. I want to buy 5 more shares. Sorry, I got a phone call there. Let me see here. Oh, I want to buy 5 more shares. At that point, it's only going to cost you $100, right? So what you're going to do at that point, you're going to average out the cost of your shares based on what you spent. So you have 5 shares at $20, 5 shares at $50. Altogether, you spent $350, and now you own 10 shares, right? So your total invested in this company, sorry, I'm trying to keep it the same font here for you guys. Total invested is $350. And then you divide that by your share price, or you divide that by your number of shares, and now you spent $35 in total to have 10 shares of the stock. Now let's say come March 1st, this stock done ran up to, I don't know, $70 a share like you predicted. All of a sudden, something happened and everybody's going crazy, blah, blah, blah. It's such a great stock. And you're like, oh, this is good. I think, this is a good point to where I can sell my stock. It might go farther than that. You don't know, but you think this is a good place based on your trading strategy and you wanting to take profits. So at that point, you're selling your 10 shares for $700. Profit, pretty easy. So at that point, you've already made, your money back and then some. Um, you know, so an extra what, $350 you've made from trading your stock. So that's what dollar cost averaging is, as opposed to if you would have bought, another 5 shares at another 250, you only made $200. You gained an extra $135, $150 just because you dollar cost average and brought your cost basis down in the stock. So that's a good strategy that a lot of people use. Basically, they wait for the stock to get at a cheaper price than what they bought it in, buy some more, and it brings down the cost basis. Dollar cost averaging. And you can do that. You don't have to do it like just because I use that time frame. You can do it in any time frame. I mean, it could be one day, another day, another day, another day. Let's say the stock price goes down and down and down, and you're trying to dollar cost average it down, and then it shoots back up. You can do that. So that's one strategy that a lot of traders use, dollar cost averaging. Other strategy that people do is based on pattern, and they do pattern recognition and chart reading, where they know different patterns that they see in different stocks and different charts, and they set timeframes to buy and sell based on what they're seeing on the chart. Let's go into, I guess, a little example. Let me see if I can pull something up here as far as, a chart pattern for you guys, just to kind of give you the thought process behind that and give you a little visual understanding of what you can do as far as pattern recognition. Now, this is typically done by day traders, scalpers, sometimes, and a lot of times too, swing traders too. They usually looking at charts too because they perform a technical analysis. That's what pattern recognition and chart reading is, technical analysis. So you won't really see position investors really do that. They're more focusing on like dollar cost averaging. Um, that's kind of how that works. So let me kind of give you an example here. Let me see if I can pull this up here. This is just an example from a website. Let's see if this would work. Because pattern recognition, there's so many different types of patterns that, you know, that are out there. It's not really an exact science, but, you know, it's something that a lot of traders, you know, look for. And because the market is made up of traders, it eventually comes into fruition when you know, make that happen in the market. Let me pull this up here. Sorry, it is freezing up on me. All right, so let's do this here. I'll look at some of these images. So most of the time, it's like breakout patterns that people look for. That one's kind of small. And that's when they decide to enter and exit. Let's take a look at this one here. This is a popular one, the head and shoulders pattern. You might have heard this from a lot of players. This is off of Charles Schwab's website. And I'll pull this up here over for you guys. So let's take a look at this. With the head and shoulders pattern, traders who see this, you know, the stock price is not really, you know, a great graph, but let me just kind of give you an idea. Let's say you checked it on this timeline here. You know, this is like January 1st, and over here is like January 3rd, something like that. At the point you see this pattern, which is a head and shoulders pattern, a shoulder, a head, and a shoulder, you're anticipating the stock to go down even more. So what a lot of traders will typically do is they'll want to short the stock because this is a bearish pattern. Again, I'm not going to get into detail of what patterns are. I do a whole bunch of different series on that. But traders who see at this point, hey, this thing is going down, or it's, you know, gone down here, they may want to short the stock some more in hopes to profit. So that's what they do at pattern recognition. They see a pattern, they can predict where the stock is going to go based on the price, and that's where they go to place their orders and profit from there. Okay, so that's pattern recognition. Momentum trading is kind of the same thing, where, you know, traders are trying to ride the price change of the stock, you know, into the momentum that's there with it running and keep going up and keep going up. They're trying to jump in and, you know, get some of those gains. Momentum trading is a lot of what I do on a day-to-day basis when I day trade. I kind of combine that with pattern recognition, but yeah, that's pretty much a trading strategy as well too. And then there's custom strategies that you'll see hundreds, maybe even thousands of other traders do. They, you know, have their own strategy. In fact, even in the course that I teach people how to develop their own strategy and what they can look for to do so. So strategies vary from trader to trader. There's no right or wrong answer. Is really what best fits for you and what makes you profitable as a trader. Okay. So that's how you're able to decide when is a good time to buy, when is a good time to sell. It's going to be based on the strategy that you're choosing. All right. So that's pretty much that. Now, when you're having your trading strategies completed, what you're doing there really is looking for, you know, key levels, key areas based on your trading strategy. Okay. And that's going to be depending upon, again, not only your strategy, but how you're able to identify things like trends, um, you know, patterns, breaking out, things like that. So one of the main things we want to focus on here, and this is typically what almost every single technical trader, you know, goes over as like a basis, is levels of support and resistance. And I'll kind of break down what that is and how you find it, and we'll, you know, touch on that in different trends and things like that. So we're trying to keep this as basic as possible. Um, so identifying key areas are a very basic foundation of technical analysis, guys. It's the most common thing to do, like I said, to calculate support and resistance. And you find those by looking at the charts. And what you're doing is you're looking for higher highs, lower lows, to find uptrends, downtrends within the price of a stock. Okay. Um, Once you find these levels of support and resistance, typically as a trader, you can execute your strategy and perform the technical analysis that you want um, to, you know, profit. So let's say, for example, like look at these, you know, here. When I say you're looking for support and resistance, you're looking at, you know, higher highs and lower lows. Uptrends will have higher lows, meaning that you'll see, like for example here, here's a low mark of where the price went on this stock. Here's another low mark. Here's another low mark. Here's a low. You see how all these low marks are getting higher and higher and higher? That means that this stock is now in an uptrend. Buyers keep buying this thing and pushing the stock up to a higher price. Now let's look at quite the opposite. The downtrend. You're looking at lower highs, which means you're looking at the highest the stock went was right here. Then it happened again, and the highest it went was right here. The highest it went was right here. For some reason, the higher highs keep getting lower. So that's pretty much how that works. Sorry, that's an alert going off. um, yeah, so pretty much that shows you uptrends, downtrends, and then there's also instances where the stock is basically trading within a range, which means it's trading sideways, which is right here in this black illustration. The highs and the lows are kind of trading typically within a channel. They're not getting higher than this or not getting lower than that. They keep stopping in between, this range. That's trading within a range, okay? And then you have, different times where it's all over the place, like this one here in the middle. The support and resistance isn't going higher or lower. I mean, it's just going everywhere, and where there's nothing you can see there. This takes a lot of practice. Being able to recognize this pattern and finding these things takes a lot of practice, guys. So don't expect to get it right out the gate. I know for me, it was tough to be able to recognize patterns for a long time. And then as I, became more experienced and started to be able to see it a lot easier. But that's what support and resistance is. You want to try to identify that as much as you can. As a matter of fact, let us go through a quick little walkthrough on doing that. I'll do that for you guys. Let me pull up a chart from some type of stock. So what I'm doing right now here is I'm going to go into TradingView. TradingView is a charting platform that traders in the market use for different things. I use it every day with day trading with the team, just to kind of give you guys a visual summary. So let's just say, let's do, what stock should I do? I mean, Microsoft or something. Sorry, it's taking so long. It's probably because the video is being recorded. There's a lot of things going on my computer right now. Let's take a look at Microsoft. Let's see how they're doing. Now, recently they just bought Activision, so shouldn't be doing too bad. All right, let's pull this up here. Let's see if we can recognize any type of patterns here. This is after hours. All right. Don't worry about all the stuff on my screen. It's just a lot of different indicators. You won't need to worry about any of that until you become advanced and want to day trade and stuff like that. But this thing kind of traded sideways within the range of, a couple of dollars throughout the day. It actually, pre-market, it had a little bit of an uptrend. You can see higher lows. Oh, there it is. Higher lows, higher lows, higher lows. And eventually, what happens when a trend is broken, it begins to reverse. Sorry, this thing is freezing up so much. I literally got like 1,000,001 programs running on this computer right now. That's probably why it's doing that. So no, there we go. All right. So yeah, it was in an uptrend and then it eventually snapped. See how quickly you can do. Now, if you're a trend trader and you had a strategy like, hey, I'm gonna get in this thing and ride this train until it snaps, that's what you would look for. That's what you would do. You would trade in that channel. It's just a quick little example. Okay, let me minimize that. So key areas of support and resistance. Traders look for things like that, and they trade according to whatever strategy they come up with that fits them. All right. So that helps you decide when to buy a stock and when not to buy a stock. Now let's take a look at how can you find key areas of support and resistance. What do you do? What can help you out with all that good stuff? Well, there are things, as you can see in that chart I just showed you, called indicators. Indicators will help you find support and resistance levels. They will help you identify certain things on a chart that you might want to look for as a trader that fits your strategy. Not all indicators work for all strategies. Understand that. So it's good to try to find what indicators work best for your strategy that will help you find what you're looking for to make the decision that you want to make to be able to enter in and exit the stock that you predict is going to happen. All right. We're coming a long way from learning how to, you know, day trade or trade stocks for, a beginner, right? But it's not too much. So one of the main indicators that help you find support and resistance levels is what's called a moving average. Okay. The popular ones are the 200 moving average, the 50-day moving average, 20-day moving average, 10-day moving average. Okay. Now, in order to utilize that properly, you got to understand what it actually is. Basically, what a moving average is a technical tool that calculates and identifies the trend by determining support and resistance levels. And it is a lagging indicator, meaning it goes off of past prices of what happens. And what it does, it shows you the change of the price over that period of time. So for example, the 200 moving average shows you the change of price over a 200-day period of the stock. Now, again, there's different moving averages. There's simple moving averages, and then there's exponential moving averages. I'm not going to get into all that because that's for another stuff for another time. Just understand that moving averages help you identify supports and resistance within the stock. Okay, and I do other videos that walk you through utilizing that as well too. All right, so let's take a look, for example, at these here. So look at this chart right here. You'll see here this indicator that they have here on this chart has the 10-day moving average of the price moving over the last 10 days in the purple, and then it has the 20-day exponential moving average happening over the last 20 days. You can tell by this indicator that this stock is in a downtrend and that it is dropping because of the fact that the price, when entering that zone of the price it was of the last 10 and 20 days, is not going above that. It's below that. So this stock is trending down, 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 down. Because these shaded areas are showing you that it is tough to break through. The market and people who are buying and selling this stock thinks that, hey, it's not really worth that much, and it just keeps going down and down and down for one reason or another. Now, again, this is like the British pound versus the dollar. Of course, this is currency, Forex. Same concept happens in stocks as well, too. Now, let's take a look at this one. This is showing you the moving averages on the lines right here. We'll just say for illustration purposes that this is a 10-day moving average. The price of the stock has been sitting above the 10-day moving average, which shows you that this stock is in an uptrend, right? So wow, the last 10 days, the average of the price has been higher. Right now, the average of the price is higher than what it used to be the last 10 days, which is this is a bullish indicator. Now at this point here, it breaks, which means at this point, stock price is going down. So the price of it over the last, 10 days, people think it's too much and it's starting to go down. The market sentiment changed towards the price of the stock. So if you kind of look at that there, again, it's just illustrating here, showing uptrend. And this right here is showing that it might not longer be an uptrend. And this is just the course of the price changing over time, the last 10 days, right? So moving averages help you find those levels of support and resistance. Based on that, you can develop a trading strategy, all right? Now, now that you know, some key things of, support and resistance, you got to wonder, Eric, what are those lines that are in there? Huh? What the heck was that? This is another thing you need to learn. And this is very important when it comes to the concept of trading. And these are candlesticks. Now, I'm not going to get into the formalities of this. There's other ways to look at charts other than just candlesticks. There's bar charts, line charts, etc., etc. Myself and a lot of other traders typically use candlesticks because of the amount of information it provides you as a trader is very, very important. Okay, because it helps you develop a strategy and predict you know, when you might want to enter and exit a trade. All right, so let's break down what these candlesticks mean. You have bullish candlesticks and you have bearish candlesticks. The colors are a formality. Um, you can, choose, depending on the charting platform you use, you can have it be green or red or black and white, however you want to do it. But just kind of understand for illustration purposes what this is. So let's start with the bullish candles. Back in the day, it used to be on charting platforms, black and white candles. Nowadays, you'll see them as green and red candles. You can do either or. But anyways, here's what these candlesticks means. You have the body of the candles and you have the wicks of the candles, okay? You'll see this throughout all candles. And candlesticks will have, certain names and certain patterns. I'm going to get into the details of candlesticks. I'll do a whole video on candlesticks and the different ones and what they mean later on. Right now, you just kind of need to know this for general illustration purposes, all right? So what this here, the bullish candle means, right here, when you see this, you'll see that the stock opened at this low and it closed at this high. These little wicks here means that, and this is within a time frame, whether it be a minute, whether it be 30 seconds, a minute, 5 minutes, 10 minutes, 15, whatever time frame you want to use. This is what's happened with the price on that stock or security within that time frame. So let's say, for example, this candlestick right here is bullish, shows you that the stock opened up at this price. Let's say this is $1, and it went and closed at $2. That's the body of the candlestick. It opened here and it closed there. The price went up. But within that, let's say within that 5-minute time frame of this candlestick forming, the price went all the way down to $1.50 and went all the way up to $2.50. That's bullish because the price closed higher than it opened. So that's a bullish candlestick. Then you have the bearish candlesticks, usually depicted in red or black. This means here that the stock opened up at $2.50, or it opened up at $2 and closed down at $1. Hope I said that right earlier. Anyways, you get the gist. So it opened up at $2, closed down at $1. But within that 5-minute time frame, it went as high as $2.50 and dropped all the way down to 50 cents. Bearish candle. This basically means that the price opened high and closed low, and people think that the stock should be going down. This one basically means that the price opened low and closed high, which means people think the stock should be going up. That's like the simplest explanation to put it. And you'll see throughout, let me pull it up again here. You'll see throughout the whole time that these candlesticks fluctuate within that time frame. So you see here, this Microsoft opened up at $309.43, and then it went all the way up to, let me zoom in some more. Let me just use this one as an example. I should probably get rid of all these indicators so you guys won't be so confused. But anyways, just kind of pay attention for illustration purposes. So let's use this candlestick here. So it opened up at 310.37 cents, went all the way down to 310.23 cents. It closed at 310.86 cents, but it went all the way up to like 310 cents, and so on with other, with other candles throughout that 1 minute or whatever that time frame is that I have it on. I have it on 1 minute. So yeah, 1 minute. I'm not saying actually use a 1 minute candle. I'm just showing you that that's how that kind of worked. And this is what happened over the course of time with the price of the stock. Okay. Candlesticks. All right, guys. So let's take a quick break. I know that's a lot of information. So we're going to recap here what we kind of touched on. Time to buy stocks, basically. We touched on when is the best time to buy stocks. We talked about entries and exits and how they will be dependent upon your trading strategy and what you formulated from doing your fundamental analysis or technical analysis when looking at your stock. entries and exits. We talked about how to find support and resistance. Okay, how support and resistance is the basis for any traders, not necessarily investors, but mostly traders who are looking to buy and sell stocks. They are trying to find areas of support and resistance where people think the price should be low and where they think the price is too much. And that helps them form a strategy of what to buy and what to sell and when to do so. We talked about indicators that you can use to find levels of support and resistance. We talked about moving averages, 200 moving average, 50, 10, 20, whatever, whatever you choose to use. We talked about those indicators. Then we discussed how to read candlesticks. We know now that prices open at one point, close at another point, whether they're bullish or bearish. And in between that time, you how much the price up and gone down at its maximum and minimum. Pretty easy. So how do we go? We're going to take a quick break. We're going to get right back into the next section and continue stock market course beginners. All right, guys, we are back off of that recap break, and we're about to get into the last little segment here of everything, kind of put it all in perspective for you, and pretty much wrap it up. Okay, so I know we went over a lot. We know about a stock, what it is. We know how to buy it, signing up with a broker. We know what happens when you execute the order, how it goes to the exchange. Excuse me. We know buyers and sellers. We know different trading strategies, how to use indicators to find price movement in the stock. We know how to do fundamental analysis, technical analysis. We've learned a lot. But in terms of day trading, swing trading, that's not really all that there is. There's a lot more in more detail, but there's still sections that we still need to cover. Now, the rest of this here might not pertain to so much value investors as it does more to day traders and swing traders and scalpers, but it still applies nonetheless. Okay, just not as heavily weighted or considered. Um, so, without further ado, let's get into the last little bit of it. So, what we're going to talk about here next is risk management. Guys, I can't stress enough how important risk management is. Not only in terms of just, being a profitable trader. I mean, it's like that in life generally. But in order for you to stay in the market for a long time, be profitable in the market, risk management is going to be very, very important for you to learn and understand. Now, I'm not going to get into too much detail here with risk management, how to perform it. We're just going to generally talk about it, touch on it, and maybe I'll do like, a few risk to reward ratio examples just to kind of give you an idea. Um, so you kind of get a general understanding. Okay. But risk management is very, very important. Know that. Practice it. Now, when it comes to risk management, I get this question a lot. How much should you start to trade with? I'm going to give you the general answer I give everyone. Don't invest more than you can lose, whether that be $2, $200, $2,000, $2 million. If you don't see yourself losing that and being okay mentally, emotionally, financially, don't trade it because the market is unpredictable. You never know what can happen. We've seen, you're not old enough. I doubt any of you are old enough to live through the Great Recession. Some of you are old enough who's been through 2008. But even more specifically, especially when it comes to investing in stocks themselves, I mean, there's things that happen. Companies go bankrupt um, overnight. I mean, some of you may know about Enron. Some of you might be too young to know about Enron. Major company that went, bankrupt due to horrible accounting practices. But nonetheless, I digress. It can't, it can happen to any company. The biggest and best can go under for one reason or another. But risk management, guys, is very important. Don't risk more than you're willing to lose. Okay, so I wanted to make that point clear. A lot of examples of why that is true and how you stay in the market. So, in a more specific aspect, how much should you trade with? Again, that depends on you as a trader. Some people are like, they want to have more than 25,000 in their account so they could trade every day, vice versa. Some people like, they only have $100, $1,000, $500, whatever. Whatever you're willing to lose, you can lose. When it comes to your account management, account size, you don't want to trade with all your position if you don't have to, obviously. You may want to, risk, on general, you'll see a lot of traders say maybe 1 to 2% of your account. Some people do more than that and a little bit more aggressive, but it varies from person to person. There's no one size fits all when it comes to risk management. That's going to be on your level of tolerance financially and psychologically. Can you handle losing that much money? Can your account handle losing that much money? Will this keep you out of trading if this company went to zero and it all went, kaput? Who knows? So, especially for you day traders and scalpers, risk management is very important. Swing traders too. Value investors can wait it out. Position traders can wait it out. So it's not that important, but it is important. Now, risk to reward ratio is important because that is how you grow your account and protect yourself from blowing your account up. As someone who has been day trading for years and have blown their account up countless of times, trust me, especially if you're day trading or scalping, more than likely it's going to happen. So that's another reason why you don't want to risk more than what you're going to lose. I'm willing to bet more likely that it would happen than it won't happen. And I'm pretty much sure I come on top. But anyways, risk to reward ratio is very important because it helps you manage your risk and stay in the market for as long as you can and be as profitable as you can. Now, a lot of times you hear traders or coaches or gurus maybe talk about what's called the R multiple, which is, the risk to reward ratio and how that pretty much works. So let me see, let me pull this up here. I'll kind of try to give you a general idea here what the risk to reward ratio is. It's basically how much your money you're willing to risk for how much you're willing to gain. Okay. To have your risk management or risk to reward ratio in place properly, you should have a trading plan, which is why we went over those trading strategies as far as when you're going to enter and exit your trade. See how that builds upon that? Now, let's say you got your trading strategy in place, blah, blah, blah. You know your entries and exit. You look at the numbers and you're like, hey, this stock here that I want to trade and X, let's see if it'll let me type here. I don't want to draw. Sorry about that. Let's do this here. Make sure my keyboard is on. Or I might draw it. It might be, okay, there we go. All right, so let's say XYZ company, probably should make this bigger for you, is currently trading, this thing is going berserk. Here, let me clear all that out. Oh well, ignore that. Let's just start new. All right, guys, so let's say XYZ company is trading at, I'm just going to use general numbers to round it off, $50 a share. Again, this is just an example. $50 a share, right? Now, you're like, okay, I feel like, I can, I think this thing might go to 80 bucks, but I'm not going to sit around and hold this stock if it goes down to, I don't know, $25. All right. So let's say your risk is at 25. You want your reward, I'll make it easier, to be 75. So you're willing to risk $25 to gain $25. That's the difference between your 50 bucks going to 25 and your 50 bucks going to $75. That, folks, is considered a one-to-one ratio. Okay. what you basically do there, take the price difference between what the share price is that you have it for now over the amount you're willing to risk, over the amount that you're, and the same thing for the amount you're willing to reward, and basically weigh them out over each other, and it becomes a one-to-one ratio. Okay, so that's pretty much how you want to define your risk management. Now, there's other instances where you might think, oh, I don't think it's going to be 75. I think it's going to go to 100. You're expecting that thing to pretty much double. All right. So at that point, you have a 2-to-1 risk to reward ratio. Okay. Because you think you're going to get twice as much here and versus cutting this in half, and so on and so on. That's just kind of like a generalization, quick way to do it. I do have a risk to reward calculator. I'm debating. I might put it in a link to it for you guys if I can find it in there. But that's pretty much how risk reward works. And a lot of times you'll see traders and other people talk about the R multiple in it um, being like 1.25, or whatever it might end up being that you're willing to risk to reward yourself. In fact, there is actually, let me pull this up here for you guys because this would be good for you to know too. In TradingView, there's a tool here that allows you to calculate risk to reward. And some of you guys in the in the group chat and you know everything that watch me trade live have seen me pull this up here sometimes, um, where you can measure your risk to reward on a chart to make it easier for you if you're going to take a long position on a trade or if you're going to take a short position on a trade. So let's say, for example, you wanted to long Microsoft, and you're like, oh, great, um, I want to do a one-to-one. Well, let me do. What's been a good one here? Let's do another stock here so you guys can get an idea. Let's do SoFi. I think they did pretty good today too. Let's say, so I clicked on that and pulled up the risk reward calculator. You'll see this right here is going to measure your risk to reward for you within a position that you're in. This right here, by default, I think it triggers like a one, yeah, 1-to-1 risk to reward ratio. See? So it's basically saying if I got in at this point here, whenever this, let's say if I got in at $14.50, right? So pretty much the risk to reward here would be, it's kind of rounded off a little bit, but you kind of get the gist here. This would be my risk to reward, 1-to-1. So this is how much I can wait for the stock price to move up or move down. If I wanted to have a higher risk to reward, 2-to-1, 3-to-1, you just raise that, and it shows you pretty much where your target would be, et cetera, et cetera, et cetera. And it works all down the line until you're pretty much done. So this thing went 3-to-1 ratio from opening bell, if not more. Okay, so that's pretty much how that works. Um, Again, not going to spend too much time on this because we got a lot more to cover, but risk management is key. Keep in mind. Now, the next section we're going to talk about here, psychology and emotions. Now, if you're an aspiring day trader or a swing trader, even a scalper, you guys need to pay attention to this section too here. This part I wish I would have known when trading in the beginning. I was pretty much just shown a bunch of stuff about support and resistance and thought that's how to trade. I've seen a few strategies about gap and goes, blah, blah, blah. No one ever really talks about too much the psychology and emotional stress behind day trading, swing trading, and scalping. Okay, because it is there. It is very, very real. Because the reason why is because you got to understand that the market itself, the whole ecosystem itself of the market, deals with traders, retail traders like myself, hedge funds, prop firms, and artificial intelligence computers, and of course, a world of economic turmoil and you know, things that happen. So the market itself, again, is, fueled by supply and demand, which is fueled by a free market economy of people's thoughts and what's going on in the world. So it's a lot to kind of consider. The market's very emotional. This is the reason why computers haven't fully replaced traders. Imagine if everything was traded by a computer, some human would figure that out and beat the computer, vice versa. If the computer, you know, that's why it probably would be a never-ending cycle of there will be no instance, in my opinion, that computers will fully replace humans as trading in the market. It's just next to impossible, just because of the things that can happen. Okay, um, psychology, thought process behind stock moving, and the process of it is very, very difficult to master. It does affect your trading decisions. Okay, when you're trading on a day-to-day basis, because you're trading with money. Again, like I said in the beginning, money fuels the economy, lifestyle, things like that. Don't underestimate the difficulty of your emotions and psychology when it comes to trading on a daily basis, and even sometimes on a swing basis. Not so much if you're, an investor and a value position trader where you just throw money at the stock, wait for it to grow. You don't really care. Okay. Also, when it comes to trading your psychology and your emotions, the reason why it's so difficult is because it does require sometimes for a lot of people lifestyle changes. And you'll see that in a lot of books that I talk about, stuff like that. Traders talk about how, when they became successful, they either stopped drinking, changed their diet, changed their sleep pattern. Even for me, especially, when I first started trading, of course, I was living on the East Coast, now on the West Coast. Time frame was different. Now, I get a little bit more sleep. I try to, if I can. Um, I exercise regularly. I thought in the beginning that, traders that said that they do stuff like this was just trying to brag about how great they are. No, it seriously does require you to change your lifestyle in order to be a successful trader, as successful as you can be. Because you have to come into the market with your head on straight. Imagine trying to trade hungover. You can't barely read the charts. Now you're going to lose a lot of money because of the fact that you can't pay attention to what's going on. Um, and it might be, I don't know, vice versa. You might need to come, on edge a little bit so you can become a better trader. It really does require a certain type of lifestyle to be a trader. And not all trading strategies fit all trading lifestyles, and vice versa. You got to find what's comfortable for you as a trader. So psychology and emotion does play a lot of role into day trading, swing trading, and scalping. Okay. Um, Also, when it comes to trading with your emotions and psychology, if you're thinking incorrectly, you're, gonna, if you're doing it all wrong and you're doing it all wrong, you're gonna deplete your capital very quickly. It's gonna cause you to break rules. It's gonna cause you to not to follow strategies, or maybe even not to see strategies that are actually there. It's been plenty of times where I've reviewed my trades like, wait, why didn't I see that before when it was happening? Because I wasn't emotionally there. I wasn't psychologically there. It could have been, it's things like that. So understand this when if you're trying to aspire to be like maybe a day trader or a swing trader or a scalper, your emotions are going to play a part into it, whether you like it or not. We're all human. I joke with my fiance all the time, like, hey, I'm just a robot. I have no emotions. But when it comes to this market, you can get very emotional. um, some of the things that tie into it, as you can see in the illustration there, fear, greed, hope, complacency, overconfidence, overtrading, regret, and despair. I kid you not, that's the nail on the head. You're going to feel all one of these emotions at some point. And I'll kind of break it down for you too, just to kind of give you an idea. So you can see this here in this illustration too. Scalpers, they have a lot of time on their hands. However, because they're scalpers and they're getting quickly in and out of trades, the way the market moves and how it moves so quickly that, even you'll see probably seeing like a movie, stuff like that, even like a millisecond can make a difference between you being a successful trader and not being a successful trader. So that comes with high risk, high reward, and that's just how it is for scalpers. So their emotions and psychologies are very, you know, next level kind of thing. To be successful, that you are a unique person. Day traders, we got just amount, decent amount of time. We got a pretty decent amount of stress, but we also have a pretty decent amount of risk to reward. That's why I day trade. I'm not in the market all day long, every minute of the day. You could be, but you'll wear yourself out. Trust me, I'm a workaholic. I know for a fact. Like it's been times where I work jobs where I'll work 40 hours and you know what like two 2 days or something like that. It's been times that I've done that. Lack of sleep, and this trading is different as far as the stress and the risks, the reward goes. You can make a lot of money. You can also lose a lot of money, but you can stress yourself out doing that. So understand that. And then swing traders, they got you know ample amount of time. Well, they're spending a lot of time in the market, um, waiting for their trades to be executed. So they, got to do a little bit more research. But the stress is low, the risk to reward ratio is low because they have time to do planning and, you know, wait for the market to come to fruition. They're not really needing to execute their trades quickly. So that's kind of the difference in the type of traders. You'll find what style fits you as a person. Um, I've done all of them, and found out, day trading is just best for me and how it works. So, but yeah, there's instances where you're going to feel fear because you're going to get into a trade that's going to drop and you're like, oh my God, I done lost all my stuff. And then there's going to be times where everything is going to be going right. You're going to get greedy. Trust me, you're going to get greedy, especially like a lot of people who trade the alerts and stuff like that in the group and chat room. Stocks will run and they'll be up hundreds, thousands, and get greedy. And all of a sudden the market changes, blink of an eye, and now they lost all of that. And it could be other little instances too where, oh, I'm in a trade and it's going right, it's going right. Oh, yeah, I'm going to let it keep running. And all of a sudden it's coming back and you know, you're losing now because you got greedy. You should have took the position and stuck to your strategy, but you didn't. You got greedy. Then there's those who are holding on in hope, bag holders, when they're in a position and it just tanks. Now they're just hoping that it comes back one day and the stock never really comes back or the company gets delisted. Now they lost all their money. When you should have been managing your risk, sticking to your strategy, and cutting your losses quickly, because that's what risk management is, your risk to reward ratio. It didn't hit where you were going to think it was going to hit, and you needed to get out. So that's pretty much your hope feeling. Complacency is going to be people who are, they're going to get complacent with, their trades. They're not going to stick to the strategy. They're going to get in, let the trade do what it does, and just take what they can and just be like, okay, I'm fine with that. When you should have stuck to the plan because the stock is running exactly where you thought it was going to be. But instead of following your risk to reward ratio, sticking to your plan, you missed out on all those gains you could have had because you didn't stick to your plan. Then there's going to be the overconfident traders. Some of you who have green streaks. It happens to me a lot. And then that one red streak you had snaps away all those wins you've had because you've been trading in confidence. You've been cocky. You haven't been sticking to the plan. You're like, I know what I'm doing. Overconfidence. Okay. Then there's going to be those who overtrade where you're taking way too many trades. I thought this was probably out of the emotions. I thought that was one of the most, oh, that doesn't make sense. That's not going to happen to me type of feelings. Overtrading is in a line with revenge trading. And I do a whole nother section on that. We're not going to get into that. But overtrading, you're trading too much. Like for me, guys, you'll know and you'll see in the Facebook groups like that, I'm only going to execute. The most I'll trade, I'll do maybe the most, maybe 6 trades a day. 6 trades. So I'm very meticulous with mine. Usually on average, like 1 or 2, depending on how good the market is. If the market's pretty decent, I might do 3 or 4, but I'm not doing no more than 6 trades. That is too much. That is, for me as a trader, that's too much. And can't, I can't do that. So you'll find your balance as a trader. But there is such thing as overtrading, especially if you're getting too confident or you're losing so bad, you're like, I just need one trade to come back to me. You don't want to do that. Overtrading. Know when to call it quits. Okay. Then there's regret. A lot of times people regret, like, dang, I should have gotten this stock instead of that stock. I should have did this. I should have did that. And that falls in line with the sunk cost fallacy. I'm not going to go into all that. I'll do another video on that as well too. So that we're not going to get into that. But that's what happens with a lot of traders. Then there's despair, where you're just down in the dumps, and there's couple of books in the Learning Lounge that I give a lot of people that will help you out with that a lot, that teaches you practices. And I talk about it in the course as well too. How to overcome that despair. When you're on a losing streak and none of your trades are going right, you just think all hope is lost. There's methods and practices you can do to get that confidence back. Okay. Um, but a lot of day traders and gurus won't touch on this stuff. I'm going to tell you guys because I want you to become, profitable. And that's pretty much it. Those are a lot of the psychology and emotions that you'll deal with in trading. I know it sounds dumb, but once you get into it, you're gonna see what I'm talking about. You're like, dang, Eric, you're right. I'm like, yeah, I know. But don't worry about it. At least you kind of you're getting more information about it than anyone else is going to get. Okay. Now let's move on. This, guys, this I would say is the most important piece. If you're a day trader, a scalper, or even a swing trader, that not one single YouTube guru or person or even, mentor that you might have will tell you about that you really need to have. And I'm like, and you won't know until you have it that you understand why it's important. So experience. The reason why you need experience, guys, and this is why the earlier you get started, the better, which is why I also want you guys to try to share this video with as much people as possible so that they can get into it as early as they can to, be the best that they can. They'll be happy that you showed it to them, especially if they're successful. Anyways, experience matters. We all got to start somewhere. That's a given. But the reason why it matters is because you have to have time to develop rules and strategies that are in place that work for you. Experience helps you understand the market cycles, also understand yourself as a trader. Right now, we're kind of in a correction phase in the market, and people are freaking out. It's actually weeding out the weak. Probably bounce back soon. Obviously, in general, markets go up, but there's always going to be some time periods where there's corrections and pullbacks and even recessions. Obviously, you can make money on both sides, but if you don't have that experience, if you don't go through it, you're not going to know what to do. So you need to be going through it, which is why risk management is key. You go through times that you don't know what to do in the market, you're not losing money, you're losing your shirt. But not only that, too, you need to understand yourself in certain conditions, know what works for you, know what doesn't work for you. It might be some days where you don't need to trade. You just sit on your hands. The market isn't telling you to trade. Okay? This is something that cannot be taught. I don't care how many online programs you buy. I don't care how many gurus you follow. I don't care how much hours of YouTube videos you watch. You cannot get hands-on experience to be taught to you. And you need that in the market. When you see the statistic that 95, 98% of traders fail, ask yourself, how long have they been trading? Ask yourself, what have they been through? Because I can pretty much guarantee you that they're probably trading less than 4 or 5 years. And here's the thing, your trading guru, your, expert, whoever you might follow, will not tell you this because a lot of times they'll tote things like, oh, in a stop, I made $1,000 today, um, you know, quickly in like 5 minutes. And obviously that's going to be appealing to a lot of people because who doesn't want to make thousands in minutes, right? But they didn't tell you the fact that they've been in the market for, years, or even if they have been in the market for years. They're not going to tell you that it's going to take that long for you to be able to make that money that quickly. And you wouldn't think that either because you know how to trade stocks. You know how to go in and out. You know how to place an order. You know, take profit. You know how to do it. But you don't know all the other stuff that goes behind it. For example, let me give you a perfect example. And I tell this to new traders all the time. The market and being a day trader, a scalper, even a swing trader is literally like playing professional sports. And I use this reference a lot. So imagine you're Usain Bolt, fastest man in the world, right? He could run probably a mile like 10 seconds, whatever the statistic is. The man's fast. Do you think he just up and all of a sudden became fast? He spent years training, practicing, running, technique, things like that in order to break records. For him to run a quarter mile in 10 seconds or whatever the statistic is, I'm sorry, I'm not a track runner. For him to be able to do that, he practiced years and years and years. Same thing with Jordan. He didn't just become great overnight. LeBron, whoever you want to choose, Kobe, I mean, Dr. J, whatever. None of these guys became great overnight. It took years of practice, years of playing, years of practice, years of playing for them to do what they do as good as they do within the time frame that they do it. Okay? Um, and that's literally what the market is. You're going against computers, you're going against professionals, you're going against hedge fund managers, you're going against other retail traders like yourself when you're doing this. Okay? And that experience and having that and going through that, getting those battle wounds really, really, really make a difference. The problem is, like I said, the gurus won't tell you that it's going to take you years. Now, there's plenty of people who are like dedicated. They learn this stuff. They catch on quickly. They take to it like a fish to water, and within a few months or so, they're just great, profitable in the market. And then there's some that take years, years. Me personally, it took me years to become good at trading. Um, but I was always interested in it. I stuck to it, and that's how I got good. You know, so don't think that I seen him make you know $5,000 in 5 minutes. Man, I want to do that. I can do that. He's just pressing the button. The stock goes in, it goes up, it goes in, it goes out. No, there was a whole bunch of other stuff he was doing before pressing that button and taking that money. Just like it was a whole bunch of things that Usain Bolt was doing before he lined up on the track and sprinted a whole mile in 10 seconds. Okay? So I can't stress that enough. When you see all those statistics again, people fail, is because they didn't have the experience. They didn't sit in the market long enough. They didn't go through a downturn in the market. They didn't do any of that. So 98% of them will quit. It just happens. All right. And because of the fact that trading is so unique, no one can teach you the uniqueness. No one can tell you what you are good at and what you aren't good at. You have to know yourself. All right. So that's that. Enough on experience. Now, lastly, here what we're going to talk about here is, how to profit on stocks. Now, I told you guys you can, profit both ways. It's actually, third ways if you're a, value investor. So you're going to be able to profit by longing a stock, which is what? The stock going up. You can also be able to profit by shorting a stock, which is the stock going down. All right. And your profits are usually calculated either in percentages or dollar amounts. Me personally, I like to calculate it by percentage because percentage trumps dollars. I'd rather see you gain 5% on your trades consistently day after day after day, as opposed to $5 or $500 day after day after day after day. Because guess what? Your 5% will grow. Compounding interest is much greater. All right. And there's a whole other video, especially in the Learning Lounge, that talks about compounding interest that is very important for you guys as stock traders, for day traders, that you should probably look at. Because a lot of people get discouraged that they have a small account balance. And some people get overconfident because they have a large account balance. And the person that has $500 who is growing their account at 5% every single day, as opposed to somebody who might have a $25,000 account and growing their account $500 every day, over time, that 5%er is going to probably beat you and have a much larger account. If all things remain the same, they stay consistent with their trading, yeah, they'll compound you out. So understand that. Um, to profit and longing a stock is pretty easy. And we'll do a quick little illustration on that here. Let me pull this up here. I'll pull up that XYZ company example here. Let me just do a new one here. So let's say, I should have probably kept that up here to make it simple. Let's go back to it. So let's say you have, make this much bigger, stock A, and you brought it for $10 a share. And then you have the stock go up. You longed it, and now the stock is worth let's just say $50 a share. You've profited the difference. Seems simple enough, right? So your profit there is 40 bucks. And this is just with one share stock. You do that with 10 shares, 400 bucks. Okay? Pretty simple. Now let's say the opposite. Instead of you long in the stock, you wanted to short it. And let's say stock A was $50 and it went down to $5. The stock has lost $45 a share. You gained $45. Or if you do 10, it's 450 bucks. That's how you profit. You get the difference. Now, quick little tidbit slash side note. In order to be able to short stocks with your broker, you're going to have what's called a margin account. Not everyone can short stocks. You have to have a margin account, and that broker has to be able to have shares available for you to borrow against. Okay. When shorting a stock, what you're doing is you're buying the stock at a high price, telling the broker slash exchange that you think it's overvalued and you think the price is going to go down, and you're going to buy it back at a different price. So here you're buying it at 50 bucks, but you think it's going to go down. And it does go down. It goes all the way down to 5 bucks, and you're saying, hey, I want to cash out. The broker gives you the difference. The problem is that borrowing these shares at 50 bucks, hoping it'll go down, comes with a cost of interest. And again, not every broker can do it. That's what makes some brokers, that's another distinguisher between brokers. Some brokers have better locates to find shares to short than others. And every broker that you want to short need to have a margin account. Because if your stock goes the other way, you have to, they're going to do what's called a margin call. And you're going to have to either deposit money into your account to cover that position, or you're gonna have to close your position. Okay, so that's pretty much how it works when it comes to shorting stock. That's how you gain. You want to get the difference. So that's how you get it from buying and selling. Now, value investors can do the same. Hedge funds, short companies all the time. You see what happened with the Big Short. They shorted the U.S. market, housing market, and Michael Burry became a millionaire, billionaire, whatever he is. Worth a lot of money. So that's what happens there. And that was considered, a value investment, because that was a long period of time for that to happen. But also keep in mind, if you're longing, you can receive dividends slash interest from, being a shareholder. Typically, companies give you dividends that are like well-established value companies. So like, who gives out dividends a lot? McDonald's, Coca-Cola, Starbucks, they all pay dividends for their shareholders. So you can make money that way as well too. Typically, when I'm value investing, I like to look for companies that's paying out dividends. And what I do is this thing called DRIP, dividend reinvestment plan, where you put the money you get paid from owning shares, it gets put right back into buying more shares, and it just grows your account exponentially. So there's that. And then there's also just making money and profiting from the growth on the stock, just like how you long a stock. Same thing, but you're doing it over a longer period of time. Like if someone, bought Tesla when it was like 50 bucks a share, and now is it like 1,000 bucks a share, they've profited that way. Um, so that's another way to profit. Okay. And that's what you as a trader, swing trader, day trader, scalper, or value investor want to do. You want to be able to profit in the market by longing, shorting, or getting dividends, or letting the stock grow. Pretty simple, right? All right. So last little bit here is just my, quick tips for you guys. Congratulations for making it all the way through this, course for beginners and learning about the stock market. I hope you learned a lot. Um, my recommendation for you guys, one thing is, if you're not feeling confident at all as far as when it comes to day trading and swing trading and scalping, don't do that. Start with being a value investor, doing fundamental analysis, learning about companies, placing 1 or 2 orders, buying 1 or 2 shares just to get the feel of it. See if it's something you like. I think we all should be investing anyway. Um, so it doesn't hurt to start out as an investor. Grow slow. Look at Warren Buffett. perfect example of a great value investor. Um, Charlie Munger as well too. So it doesn't hurt to be a long-term investor. I'll put links of brokers you can sign up with in the description below as well too. Use the links. Full disclosure, sometimes they give you free stocks, sometimes they don't, depending on what's going on. But I'm just putting there for your convenience. You don't have to use them. um, Typically, another good tip I tell people is, when you sign up with your broker, just as far as deciding which one to go with, make sure they're FDIC insured. Basically means that if something happens to the broker, that they'll, you get paid. You're insured by the, FDIC. Because, companies like SureTrader that went under, um, you know, could close down and take your money. But then there's other companies that like get discontinued or just don't have funds to operate. Like for example, U-Trade is getting, discontinued. So just make sure your funds are safe. Another tip for you guys is, don't be afraid to start small, especially if in the beginning. I recommend you starting small, and I recommend starting with big name companies like Microsoft, Apple, or even look into trading index funds and ETFs. I didn't go into details of what ETFs and index funds are because I'll say that for another video. It deals with just a collective of stocks, just to kind of give you a brief idea. A collection of stocks that represent, certain aspects, either like sectors and things like that that you can invest in. But yeah, start with bigger companies. It might be more slow moving, but it's just for you to get a good feel of it um, and understanding how the market works. Start start with a small amount, but working with big companies. Then if you decide to do day trading or swing trading, you can do that too. You can typically, I think this order is the best. Start with big companies in a small account that you're trading with, and then as you're getting better and more familiar with it, you're taking more of a risk. You can go down to swing trading, getting better at fundamental analysis and technical analysis, maybe even putting more into it to risk as far as your account size goes. And then as you become better at that, you might want to look into day trading and then growing into scalping. Eventually, that's like the quickest way you can trade and be profitable. So kind of do it in that order. So that's pretty much how that goes. That's my tip and recommendation there. Now, risk management is definitely something you want to practice as well too. That's my tip there. That's usually one of the bigger hurdles after you've become good at fundamental analysis and technical analysis. Now is working on risk management. Definitely something you definitely want to do and practice. And over time, of course, experience will come with that and the psychology of understanding yourself in the market and how it works will happen as well too. And then lastly, this is like the biggest tip I think I could give you guys is to surround yourself with like-minded individuals and traders and stuff like that. Me, I'm naturally kind of like an introvert. I can be extroverted when I can, so they call me like an omnivert. But you know, I didn't think that being around other traders would help me, especially when I started out in this. Seeing online there, you got all these places saying, "Oh, join our Discord or chat room and stuff like that." And obviously you got to pay for that. And I started out, I didn't do that because I didn't have money to do that, and even when I did, I thought it was useless. But I didn't really interact like that so much. I recommend you being around groups of traders, ask questions, even if you think they're dumb, ask them. Okay. We have our free Facebook group. I'm debating if I'm gonna do like a Discord or not. We have a free Facebook group, guys. I'll put the link in there for you. Feel free to join us. Of course, we do have the paid chat room and everything like that. But that's for like active traders, people who are profiting every day and stuff like that. Really tight knit community. We try not to let just any and everybody in, so that you can grow as a trader. You guys can bounce ideas off of each other, and you'll see in like that group too that nobody trades the same. Everyone trades different, but we all give each other different insights and what we're looking at, and it helps out tremendously. Um, I definitely underestimated that in the beginning when I was, trying to start out day trading. I wanted to take it really serious, but I didn't know how much that would have helped me if I would have been talking to other traders. And sometimes you don't know what to ask, but you'll see things in a chat room and hear things that might pique your interest, and you'll look into like, oh, maybe I can do that, or maybe I can try that, or maybe I should look into that. So you're kind of cheating yourself if you're not, being surrounded by like-minded traders because you're not going to know what to look for, especially, starting out. So, and that's why our chat room, we try to keep, price low so that the barrier to entry isn't, difficult for people. I've seen, chat rooms cost hundreds and thousands of dollars. Like for what I couldn't see myself, because you don't know the value in it. You can't really see yourself getting it. So we try to keep ours reasonably priced so that anybody can join and learn and become better at trading on their own accord without breaking the bank, because you still need money to trade with. And that's really a lot of what I'm trying to do here at Traveling Trading, is help people become traders or find out for a fact if trading is for them. It's not for everybody. I'm not gonna sit there and lie to you and tell you, oh, you can make a change in your life and all things will be great. Typically you can kind of tell what person wants to be a trader and what person doesn't. It's really not that hard to decide. Me being in this for a couple of years, I know people who are dedicated to being a trader, and I've seen them grow and progress. And I've seen people start it thinking it's fast money, and they figure out how much you have to work into day trading and scalping, and they quit. There's nothing wrong with that. Again, it's not for everybody. Just understand that. So, but it's good to know for a fact that that happens by being around like-minded individuals. It definitely helps you grow. So I'll put the link to the chat room in there too if you guys want to join that. If not, join the free Facebook group just to be in there and get information. I'm in there talking a lot all the time about different stocks. And it doesn't hurt to stay up to date on what's going on in the world and the economy. You live here, you live on this planet. Until we get to Mars or somewhere else, you need to, be in touch with what's going on in the world. It's your world too, okay? So with that being said, guys, that is a wrap. This has been tremendously fun. So I hope you guys got a lot of information. I hope you learned some things. And this is what I'm going to try to continue to do here at Traveling Trading. Please, please, please don't forget to like, subscribe, to the channel. Definitely comment below, even if it's just a thumbs up, or, even if you just want to put a period, put something there. Just do that for me. Hopefully I didn't take too much time, but if I did, hopefully you learned something. If you guys have any questions, definitely put them in the comment section, because I can get those right away and I can answer those as quickly as possible. Ask them in the Facebook group, follow the IG and all that other good stuff, TikTok, all the other social media things, whatever you need to do. But anyways, hope you guys have a great time and enjoyed this. Until then, I'll catch you next time. You guys stay green.